First thing is to say to Alex, well done in building up Share Talk. And as among your earliest supporters, we're delighted to see it's reached this stage where we can come and give a presentation here with you in Birmingham. And so congratulations and thank you for inviting us. Thank you also for arranging that we didn't have to be followed immediately by Metal Tiger. I was afraid that, although I was personally looking forward very much to hearing them speak, because as a shareholder myself, I was really interested in what they might have to say. I did think that if they were following us tonight, nobody would remember a single thing about what we said, because they would take all the attention. So thank you for arranging for them to be unavailable. This is the standard disclaimer that we have, and I'll go very quickly through the presentation, pass over to Scott to talk to you about, in particular, a new investment that we're making. And after that, at the end, we announced something yesterday which won't be part of the presentation, because the presentation is so beautiful stylistically that it'll take a long time to incorporate this new information into a revised version of the presentation. But we have 3 slides to explain in outline what we're doing, which will be shown as a sort of addendum at the end. So to start with, here's what we have. We have the Motzfeldt project in Greenland, which is niobium and tantalum JORC resource, the biggest tantalum resource in the world and largely unexplored in this area. We picked this up opportunistically because it became available. Westport Energy is one of the investments that we are making because we had this strategy that we would look for things in the oil and gas market that could produce cash flow and that were coming out of bankruptcy or insolvency. And this met that criterion. Horse Hill is our onshore UK oil and gas exploration in the Wheel Basin near Gatwick Airport, where we have a small stake. And you've probably read about Horse Hill. We've heard from some of the other participants. And then we have Mambari, which is our large nickel JORC resource in Papua New Guinea. It's one of the largest lateritic nickel cobalt projects in the world, and we've only explored a very small part of the resource. But Motzfeldt and Mambari, we have in the recession for the mining sector just concentrated on holding on to. And our strategy has been to try to add cash flow by finding things that could do that. And we will speak about that a little as we go through the presentation. But we have 2 huge projects, therefore, with very large resources. But the problem with having elephants like that when you're a small company is they don't produce cash flow, and you have to find the means to retain them until the time comes when they perform. So here are our 4 strategic areas. In the middle you see oil and gas and mining. And oil and gas is the coal bed methane, that's Westport. Onshore UK oil and gas, Horse Hill. Mining is nickel in Papua New Guinea and the niobium tantalum in Greenland. We're doing due diligence on this new thing we announced yesterday, which is metallurgical coal in the United States. I'd say that's between oil and gas, and mining straddles the 2. Then investments and transactions. We've always been transaction oriented. If we can act as a kind of mini merchant bank and do things like that, we do. We did that in Australia in the last year or 2, where we got some tenements, put them into a listed company, and then sold shares in that listed company, let the management go off and do its thing. And then investments, we have some investments in other listed companies. I suppose you could say that the Westport coal bed methane is an investment in a sense, because it's going to be listed. So there is some overlap. The things that are transactions or investments may be in oil or gas or mining. The investor timeline, we're going to have an end to the due diligence period on the coal 24th of December. On probably the last day of the year or just before, we will have our annual general meeting, and then the Westport PLC IPO is expected in January. That's the coal bed methane, and Horse Hill long-term flow tests arrive in February. So those are 4 things we can point to that are certain on the investor timeline, we think. But in fact, with the Rosa metallurgical coal, there's probably going to be a series of announcements over time. Oil and gas, the first sector, Horse Hill. Testing has already taken place in the last year. We have a small stake. The results were extremely good. The flow rates were very high, and not just from the Upper Portland sandstones, but also from the Kimmeridge, which is the main horizon producing oil in the North Sea, but which has been thought to be too thermally immature in the Weald Basin to have generated oil in the oil window. This turned out to be completely wrong, and the area has had to be reinterpreted, and the BGS is having to do a reinterpretation of the Weald. So very exciting, could be huge, and it's not going to be quick. It's going to take time. It's going to cost a bit of money. Next door, we have another company that has drilled a well and is producing from the sandstone, and is just getting listed and is planning to put down a well to these levels to see whether there's continuity. And there is a possibility in future we could cooperate with them. They could use one of their redundant wells to come sideways into our area there, and that might produce earlier cash flow. We'll see. So the Horse Hill timeline as we know it at the moment is this, but there could be developments, particularly with Angus Energy listing now on AIM, which would change the sequence. This is the ownership structure, and you see us up there and you see the other participants. This presentation, by the way, will be on our website. I now come to Westport Energy, and since Scott is going to be our representative on the board there, and therefore has been working with the team as they move towards listing, I'll pass over to him now.
Thank you, Andrew. I'll cover here in brief our Westport investment, one which we're very excited about. This is a project it's close to our heart because we think there's a lot of interesting aspects to it. In particular, it's because it fits the criteria of the investments we've been looking for, and the fact that this is an asset that's been in bankruptcy for the last 6-7 years. It has a historic spend of $75 million on it, and we're going to IPO it here in London for something approaching £5 million, of which Regency should end up with something like 10%. So we feel that this meets the criteria of the type of investments, bottom of the cycle type valuations that one can get into, and that we feel we have the most upside for the business. There's a lot of detail here. We'll skim through it. The asset's located in Arden. It's a coal bed methane project. Regency is going to put approximately 500,000 pounds in it. We should end up with about a 10% stake. And we hope cash flow indicative to Regency should be in the $20,000 to $25,000 per month range once it gets going. That's in a stage one. Beyond that, we would expect more. There's a couple of plans here how they're going to develop the asset. We'll cover that in a second. But in general terms, we expect this to be IPO'd probably January at this point, and then first gas 6 months thereafter. So this is the development plan. The 5 wells in black that you see there exist today, and that's why this project is so interesting. As I said, $75 million was spent here. These wells exist. They're just turned off at the moment. Frankly, they haven't ever been hooked up to the main pipeline. So the graphic there in the middle, the 12-inch Coos-Bay pipeline crosses the property. It's 200 meters from these 5 wells and has never been hooked up. Again, it's sort of a typical, this is why it's so attractive to us. This has been sitting here for years. It's been held by a hedge fund, frankly, in a bankruptcy type situation. They're foreclosing on it. They're putting it into Westport PLC, and they're going to list it here in London with us as partners, like I said, probably in January. There's 2 horizons being exploited here. One is the upper Colado, and the other is the lower Colado. The lower holds the majority of the gas. Phase 1 will be the IPO, and fundraise, followed by 2 additional wells. So it's the 5 black wells you see there, plus the 2 little white ones at the bottom. That's what we're calling phase 1. That's designed to really find out, is this going to be commercial? Is this going to go forward? And then if it does, there's a variety of plans to take it from there. Phase 2 would have us drilling 58 additional wells. That's the big white mass you can see in the middle there. And then a follow-on phase 2 will bring it up to 200 wells, or phase 3 beyond that. Typical well, as you can see in the top right there, is about $350,000, so they're not particularly expensive to drill, and you're drilling 2,500 feet, so again, nothing too technically challenging here. This is the typical economics of a well here. As I said, about $320,000 per well. The NPV looks particularly attractive, phase 1 in particular, because again, a lot of the infrastructure is already there. The 5 wells exist, they're going to be re-entered, they're going to be turned on and hooked up to the main pipeline. So you're looking at an IRR of 108%. Give or take, CapEx 1.1. So again, not a particularly a lot of money to find out whether this is commercially viable or not. And that's probably what made it attractive for us to get involved, because it's not very much money up front, figure out whether this is going to work, and then either take it forward or go a different direction as makes sense. Phases 1 and 2 there in the middle, again, you start to ramp up the number of wells. The amount of gas you're associating or accessing grows up to 30.8 BCF. looking at net revenues at 141. So again, you start to build a sizable gas company at this stage. And again, we expect not to be particularly diluted because it won't take very long before we'll be able to put debt on a business like this, meaning that Regency stake should remain roughly 10% for the foreseeable future. And then, as I said before, the 5-year plan would involve 200 wells, and they're hoping to value this asset or this company on the London Stock Exchange at around 200 million. Again, hopefully Regency keeping something around its 2.2%. To give you an idea of what a typical well should produce, on a per well ultimate recovery basis, they're expecting about 500 MMCF, and on the peak rate, it's about 150 per day, 150 MCF per day. So that's roughly in a barrel of oil equivalent. That's something like 30 barrels of oil per day per well, multiplied over all these different wells, and an IRR on a typical well of about 55%. And again, that's a new well. The existing wells obviously are going to turn out better than that. A little bit about coal bed methane and natural gas generally, and why we thought that the investment thesis made sense. Right now, coal bed methane already is 10% of U.S. natural gas production. It's considered by many to be the fuel of the future, and that it is the fossil fuel that is clean enough to be politically sensible, that it's continued to be developed. And as the world moves to electric cars and electric batteries take precedence, you would expect natural gas to be powering a lot of that to make up with renewables. Interesting, it's coal bed methane is both a reservoir rock and a source rock, in the sense that it isn't gas migrating from one place to the other. The gas is already there. It's just a matter of accessing it. And traditionally, of course, as many people might know, methane actually has been quite dangerous. And so in this case, what they've done is they've turned something that traditionally was a miner's curse, as they called it, and actually making it economically viable and turning it into natural gas production. So we looked at all these aspects when we went into this investment, and we found it attractive. We feel that Westport's likely to do well in the London Stock Exchange, and it'll be a direct benefit to Regency shareholders as we continue to grow the company. As far as our existing mineral projects, we have 2 big ones left. Motzfeldt, as Andrew already said, is one of the world's largest undeveloped niobium and tantalum resources. Also has indications of rare earth elements. This is a project, as Andrew already indicated, we picked up for nothing, effectively less than 3,000 pounds. And we've been sitting on it for the last year or so, looking for ways to take it forward. The in situ value here is significant, and these minerals are particularly attractive in today's market with uses in batteries, electronics, something like your iPhone, for example. So we feel like this is a project that, if we can find the right access way to take it forward, really does have potential for us. It's a minimal spend to hold it in the meantime, so it's basically just all upside for Regency investors at this stage. And then this is Regency's classic project, I should say, which is a large nickel project in Papua New Guinea on the Mambari Plateau. It's one of the world's largest undeveloped single nickel laterite deposits, and we operate it through a joint venture with our partner there, Direct Nickel, who's recently gone through a restructuring. So it's a large project, 162 million tons, a lot of nickel in the ground there, and you can see at 47 million tons, a little bit higher cutoff of 1.23%. The other interesting aspect of this is that we have a license to use our partner's interesting technology. It's the DNI process. We can do it on this project and potentially even a second project. And it really offers the chance for projects like this to be taken forward in a cost-effective way. It has lots of advantages as regarding the acid that it uses and the scalability of the project. And we've been working now for several years with DNI to find the best way to take this forward. DNI has restructured in the past 6 months, and it's sort of recapitalized itself with new ownership. And we run an operating joint venture committee with these guys, taking this project, trying to keep costs down as we look for ways to develop it and try to monetize it for our investors. And then finally, other investments. Regency has exposure to a number of other things, and I think that's partly why we think the investment thesis is interesting. When you buy a Regency share, you're getting a lot of different exposure. That map said it at the beginning, and I think you can see it here as well. We have exposure to Red Rock Resources, a small holding of 2%, which gives us additional oil and gas assets, and in particular gets us exposure to a large producing manganese asset in South Africa, as well as some gold exposure in Kenya and a few other, and oil production actually in the United States. Direct Nickel I covered somewhat, as they're our partner in Mambari. We have a small holding with them, and again, their prime focus going forward is to take their nickel technology to commercial use, to continue to license it out, and any success that they have in doing that over the next couple of years should feed directly into Regency's bottom line. And then finally, Andrew mentioned on Friday, we actually just announced a new met coal project in Alabama. We are in the due diligence phase on this, so we can't say a whole lot about it. But the plan is to reactivate an existing met coal mine there. We're going to be investing $50,000 up front, which is refundable, and $200,000 probably in 4 to 6 weeks if the due diligence goes well. It has an NI 43-101 already in place and 453,000 tons resource there. This is simple production. Met coal prices, as many of you probably know, are very strong at the moment, and we saw this as a key element of our platform to get revenues into Regency in the short term on a monthly basis, starting potentially as soon as 6 weeks if all things go well and we decide to go forward with it. So to summarize though, let me speed this up. We feel there's a few aspects of why Regency is an attractive share at the moment. Again, we feel like we're getting into new investments at the bottom of the cycle, and that's to the benefit of everyone. We feel we bring a diverse asset mix to the table, both historical mining assets, some of these really significant large assets, as well as smaller yet potentially more cash generative oil and gas assets. We think the core investments have huge upside here, and we think we've laid both the foundation for outperformance, both through cost reduction and through positioning in these various projects over the last few months.
That's right. We can't tell when nickel is going to jump. We can't tell when the green commodities are going to jump. What we know is that in the last year, one or two commodities have jumped very sharply. One has been manganese that we're exposed to in a different company. Another has, of course, been metallurgical coal, both two key inputs into steel making. And the manganese prices come from $1.32 at the beginning of the year to about $7, $8 per DMTU now. And coal has also gone up about 4 times. We, with this investment, are looking at something where, once again, we're taking something out of bankruptcy or essential insolvency. And you look at this basin, you can see on the right-hand side, going down through the Appalachians from Virginia, West Virginia in the north, and down to Alabama, where you see that little sort of square at the right. That's where we are going to be doing this project. It's an old established coal project. Incidentally, that little area in Alabama, that south end there, is where the shale gas started in America and has still produced really a huge amount, the second biggest producing area. So there's a lot of potential. Now, the type of mining there, what makes this attractive to us, I think, is it's really, really, really simple. Not only should one be potentially getting up to $100 per ton profit, but nothing much can go wrong with this. And we have learned the merits of simplicity in mining and operating. This is a form of contour mining. In other words, you're going in from the side to a horizontal or near horizontal seam, and you can do this either using an auger, and here is a model of an auger here, which you see is basically a kind of screw. Or if you want to go further in to one of these sort of holes, again, without using people going underground, so minimal manpower, or very cheap, you can use a high wall miner. That, as you can see, is a slightly more complex bit of equipment where you have a little bit more control than with just the straight screw of the auger. But these are the techniques that will be used there. And not only do they have the equipment to do this, but they have a preparation or washing plant already constructed, which, whether you consider it worth $4 million written down, or is this quite a new plant, the replacement cost of $12 million dwarfs our investment cost of £250,000 potentially for a 20% stake. So we're looking at this. We think it's actually an extremely interesting opportunity because the shareholder agreement there, if we proceed, is going to be on the basis that the money made gets paid out to shareholders straight away. So we'll have an effective constant cash flow from this. And that, we think, is tremendously important going forward, because we've learned that to do a small exploration company and to be dependent on exploration money is difficult, particularly when your projects are huge in potential, but you have to have patience to see when they're going to come through. You need to have things that have growth, but also profit as well. And so we've added in these things opportunistically at the bottom of the market, coming out of insolvency, assets that we think can create a new Regency for the future. Thank you very much for listening to us.